Hi, everybody. Thank you guys very much for joining us today on the key due diligence steps for any real estate investment inside your self-directed IRA. My name is Matthew Owens. I'm here with Karin Hall from UDirect IRA Services, and we're here to teach you a little bit about how to actually invest through your self-directed IRA, some of the key things involved with it, as well as to learn how to do it right and learn how to do the right due diligence and make sure you're doing things right within your IRA, because it's so important to make sure that all your I's are dotted and T's are crossed here with regard to investing inside your IRA. A lot of people actually that I've met think that it's very, very difficult to do this, but actually it's really, really simple if you have the right custodian and the right system set up and know some of the rules involved. So I'm here with Karin right now, and I'm going to change presenters over to her really quick, and we will get started with the education. Thank you guys very much for joining us again. Let me switch it over here. Okay, there we go.
Thank you, Matt. I appreciate it. All right, we'll get this going. As Matt said, my name's Karin. I'm Karin Hall and president of UDirect IRA Services. So what we do here, while I'm getting all this set up for you, is we help you self-direct your IRA. And so what we don't do is we don't give you tax advice or legal advice. You know, we're not CPAs or attorneys over here. We're not financial advisors either. So we're never going to tell you what asset to invest in. We don't recommend any particular investments. But what we do, here at UDirect is help people to move their money from where it is, usually invested in the stock market, out into the kinds of alternative assets that they select. I mean, that's why we call our company UDirect IRA Services, because you direct what your IRA invests in, and you're the investment, expert in this case, and so we're taking your directions, and that's how self-directed IRAs work. We're passive, and we're going to take your orders pretty much. I mean, we're going to look at what you're doing, see if it's administratively feasible, but pretty much it's self-directed, or it's entirely self-directed. Okay, so the whole point of self-directed IRAs is saving for retirement. Boy, you just can't stress this enough. No matter how old you are, now is the time to start saving for retirement, because I'll tell you what, it's coming at you like a freight train. And anybody who has children, or nieces and nephews or something, and you can see, wow, I can't believe they're so big, look how fast they grew. Well, that's how retirement is coming to your door. So make sure you save for retirement. Americans have a huge deficit between what they have and what they need. So you don't want to be a statistic. You want to save for your retirement. That's what IRAs do. Self-directed IRAs, regular IRAs. And with self-directed IRAs, anything you invest in is for investment purposes only. And when you're investing, it's for retirement purposes only. So that's something to keep in mind. The total retirement funds, something like $26 trillion in America, saved for retirement. Now, only around 4 or 5% of that is in what's called alternative assets, basically meaning not the stock market, not stocks, bonds, mutual funds, annuities, that kind of thing. So there is a huge pool of money to draw from if you are raising capital. You can ask people who may want to invest, hey, do you have an IRA? Do you have a 401k with a previous employer? And if they say yes, chances are they can move their money from where it is into a self-directed IRA and invest in your deal. So if you haven't heard about self-directed IRAs, I'll tell you what, you're not alone. A lot of people have not heard about this. I kind of call it the best kept secret, because you've been able to self-direct your IRA for 40 years. I think that's longer than you've been alive, right, Matt? I think so.
Exactly, it is. It is.
I caught you off guard there, sorry. But so for longer than Matt has been alive, you've been able to self-direct your IRA. And look how old Matt is, Just kidding. So basically, not a lot of attorneys know about this, or CPAs, but when Gerald Ford signed the ERISA laws into effect in 1974, they went to effect in 75, the IRS basically just said, hey, this is what you can do and this is what you can't do, and we'll cover that in a second. So what's the difference? A typical IRA is invested in the stock market, stocks, bonds, mutual funds, CDs, annuities, that kind of thing. A self-directed IRA is, it's a traditional, a Roth, a SEP, a simple, a spousal IRA. It's the same kind of IRA. The only difference is the kind of asset that plan can invest in. So with it, when you've got a self-directed IRA, that really just opens the door to an entirely different class of options, like notes and properties and LLCs, which is private placements, tax liens, private lending, trust deeds, all different kinds of things that your IRA can do now that it can't do when it's in a typical IRA. Now, this is a big deal, and this is really the focus on our conversation today, and Matt is going to go deep into this, but what about losses? You don't want to lose money in your IRA because you don't get to write it off, and it's really hard to replace that money, so you need to do your due diligence. And Matt Owens is here to talk to us today about due diligence with investing. You want to do your due diligence on the front end before you invest. You want to do your due diligence on the back end after you invested. Hey, after you invested, did it get recorded? Did everything get cleaned up correctly? Is everything, did everything happen the way it was supposed to after the deal? So you do your due diligence before and after, and Matt is going to elaborate on that for us in a little bit. So what are the limits with these self-directed IRAs, right? Well, the IRS, they don't say what you can do. They only say what you can't do. So you're not going to invest your IRA money in life insurance contracts, and you're not going to invest your IRA money in collectibles like a fine wine collection or collectible cars or something like that. So that's what the IRS says. They say that's the only two things your IRA can't invest in. Now, we also, every single different self-directed IRA provider has criteria. There are things that we say, well, that's not administratively feasible. Like, for example, if you want to invest in livestock, it's kind of hard to custody a cow. There are companies that'll do it. That's one asset that for us, it's not administratively feasible. I don't know how many cows you have in your office, heads of cattle, or perhaps an entire herd. I don't know. But in our office, we're livestock free. So that's one asset that the IRS says you can invest in, but for us, it's not administratively feasible. Just a good example. So you found something you want to invest in outside the stock market. You have retirement funds, but though that money is with your current employer, and you're thinking, I think I'll use my 401k. Well, chances are you're probably not going to be able to do that. You really have to wait till you leave the service of that company before you can roll over the money. And so what you need to do is talk to the plan administrator. Go ahead and ask them, hey, can I have an in-service transfer? I'm working here. I'd like to move my money. Can I have an in-service transfer of my 401k, my 403b, my 457 into an IRA? And they're going to tell you yes or no. So there you go. So if you work somewhere and you want to use those retirement funds, pretty much the answer is no, unless you get that in-service transfer. Now, no conversation about IRAs is complete without talking about the rules, and the reason is because the self-directed IRA game is a game that you want to play to win, and like any good game, it's got rules. Just follow the rules, like Matt was saying earlier. You can do this if you just know how to do it. So let's talk about the rules. Some of them, and a discussion about IRAs, a really clear, concise discussion about IRAs is written on the IRS's website, irs.gov, publication 590. Check it out, read it, and you're going to learn there that you're not going to borrow money from your IRA. You're not going to sell property to it. I got that call today. Somebody said, yeah, I've got this property, and I'm trying to look for a way to shelter some tax income. Can my IRA buy this property that I own? And the answer is no, your IRA cannot buy a property that you own. You're not going to use your IRA as security for a loan, and you don't use it to buy property or assets or anything like that for your personal use. It's not to use to have personal benefit now. It's to benefit later in the future. So basically you're never going to live in it if it's a house, that sort of thing. Okay, so more about the rules, and I don't know anywhere else where this one applies, but some people are qualified to your IRA and some are disqualified, allowed and disallowed. So the disallowed, disqualified people, those are your lineal ascendants and descendants. It's your parents and grandparents and their spouses, you and your spouse, and your children and your grandchildren and their spouses, all disallowed to the IRA, plus anybody who's offering services to the plan, like a fiduciary, which would be like a real estate agent, for example, would be disallowed. Now, the qualified people are the people out to the sides on your family tree, like your aunts and uncles, your cousins, your brothers and sisters, nieces and nephews, and your friends, of course, those people
Muted.
out are qualified. So it's really important to ask yourself when you go to invest, is my IRA about to do business with someone who's disqualified? Because if the answer is yes, you can't do it. So let's cover these rules. I mean, the
Unmuted.
game is a game of keep away. It's keep away from prohibited transactions. You want to bring in the green and push out the red, right? So bring in the money, push out the prohibited transactions. Neither you nor any of those disqualified people can benefit today from the IRA. You don't buy, sell, or exchange assets between the IRA and one of those disqualified people. And these disallowed people, they can't provide goods, services, or facilities to the plan. So, for example, you're disallowed. So maybe your IRA buys a house and you think, oh, that's great because I'm really good at drywall. I think I'm going to, rehab this house my IRA just bought. Well, the truth of it is the IRS calls that an overcontribution of sweat equity. Plus, you're a disallowed person and you can't offer services to the plan. That would be a prohibited transaction. Don't do it. Same thing if it's your parents or your kids. They can't provide goods, services, or facilities to the plan. The rule of thumb here is just keep it arm's length, and then you'll usually be fine. If you don't know if it's prohibited, call us, because we deal with a lot of those questions every day, where people are calling us saying, hey, this is what we're looking to do. How does this look to you? And so we'll give you our contact information at the end. Now again, about playing the self-directed IRA game, who are the players in the game? I mean, you're not gonna go suit up for a game and not know the rules, right? And you're not going to know who the players are or what their positions are. So there's you on the one hand, and then there's your IRA on the other hand. When your IRA invests, it's different than you investing. For example, if your IRA is buying a house, you don't sign the offer to purchase. We get it signed for you on behalf of your IRA, you see. So you can sign it as read and approved, but we're going to sign the actual documents on behalf of the IRA. Then there's UDirect IRA Services. And when I founded this company in 2009, I sought out the custodial services of several different companies. I talked to a lot, and finally decided to work with a trust company custodian. So these are all the players in the game. And plus, well, I guess we could add more players. I mean, those would be the asset sponsors and so forth, and the people that offer the investments themselves. But remember, with a self-directed IRA, we never tell you what to invest in. You direct your IRA entirely. Okay, how do you get an IRA to buy like a house, for example? How do you even do this? We all know how to get stock in our IRA, right? You go online, click a few buttons and click and purchase, or maybe you have a financial advisor and you say, hey, look, I'd really like to balance my portfolio in this way. So you know how to do that. But when it's a self-directed IRA, very common misconception is that you're going to take the money out of your IRA, have a taxable event, and then buy the asset. That's wrong. You don't do it that way. Just like your IRA can buy a share of Apple, your IRA can buy a house. It's just a different kind of asset. So say, for example, your IRA is going to buy a house. First, open a self-directed IRA. And I say that because you open it, takes a day, but to get the money into the IRA from where it is probably going to take about 2 weeks. So you want to have that account open and funded before you shop for an investment so that you can make that earnest money deposit in, so that you've got the money in there to pull the trigger on the deal. Remember, the IRA is the buyer, not you. So the name of the investor is Custodian for the Benefit of the IRA, and we're going to get it signed for you on behalf of the IRA. So you give us a direction letter. It's our one-page form. You give us the supporting documentation, which is the contract. Like if it's a note that you're doing, it's a note. If it's you're buying a house, it's the offer to purchase, or if you're maybe investing in a private placement, it's the subscription agreement. But you give us the supporting documentation, we review it, and assuming everything looks administratively feasible, then funds get wired, and everything goes through closing, and now your IRA owns that asset. Now, if it's a house, or no matter what it is, all proceeds must go back into that IRA. The proceeds from that investment never go into your pocket, okay? If you want to have personal use of the money, what you do is you put that money in the IRA, and then fill out a withdrawal form, and then we send it to you. In this way, everything is tracked by the IRS, and then you're doing it correctly. So you want to do it correctly, because if you commit a prohibited transaction, if you do it incorrectly, what happens is your entire IRA, all right, not just a little bit of it, but the entire IRA can be dispersed to you as a taxable event, and you you don't want that, right? That would be bad. So we want you to avoid that at all costs. So we're going to pass through that and talk about something else that's wrongly called a checkbook IRA. That leads to a lot of misconceptions. When you open a self-directed IRA, it doesn't mean you get checkbook control automatically. That doesn't happen. It just doesn't happen. But your IRA can buy 100% of the initial units of a special purpose LLC, not an LLC you already own, but a brand new LLC that someone else sets up for you. Because remember, your IRA can't buy something you own. So your IRA buys 100% of those initial shares. You're the managing member, and now the money goes from the IRA into the LLC's checking account. As a managing member, you have signing authority and check writing authority, and then you can do that. But remember, with great power comes great responsibility. So if you're going to have one of these IRA-owned LLCs, you really have to be on your toes with regard to the rules, and you need to follow them so that you don't get in trouble. You don't have your IRA dispersed to you. So when we talk about the self-directed IRA, that's kind of a catchphrase. It covers so many other things. It's like an umbrella phrase that means all of these different things. We also offer the individual K, the 401k for a single self-employed person. So if you're self-employed, you have no full-time employees in any of the companies that you own, well then you can have an individual K, and it's got a lot of bells and whistles. Higher contribution limits, you can have a Roth bucket, which is great. You can take a plan loan, and there's special criteria for that. But also with the IRAs, it's a traditional Roth, SEP, simple, spousal, inherited IRA. So all of these kinds of plans can be self-directed. Now, how do you do this, right? Open, fund, invest. Open an account, transfer your money, roll it over, or contribute, and after your account is open and funded, you give us a direction letter, you give us the supporting documentation, we review it, and then the funds go out in your deal, and now you have self-directed your IRA. Remember, all proceeds have to go back into the IRA. All expenses of the IRA must be paid for by the IRA, okay? So that is a quick run-through on self-directed IRAs, what they are, how they work, the rules in general. But if you have questions that you'd like to ask me just one-on-one, send me an email, khall@udirectira.com. And because you're one of the exceptional people that cares about due diligence and that you've tuned into this webinar, what I'd like to do is extend an offer. And Matt, you can go ahead and repeat this at the end if you want, but if you will email me and in the subject line write free book, I will send you a free book called the IRA, the Self-Directed IRA Handbook, which tells you the rules. Because, again, if you're going to play this game, you need to know the rules. So if you email me again, khall@udirectira.com with the subject free book, I will send you a copy of the Self-Directed IRA Handbook. And with that, Matt, I'm going to turn things back over to you, and thank you so much for having me as a guest on your event today. Really appreciate it.
No problem at all. Always great to have you, Karin. It's amazing the knowledge you dispel on this stuff. And, I know you do a ton of different presentations all the time for people, and it's amazing the amount of influence you've had and the amount of people you've been able to help to self-direct their retirement. It's one of the most important things I think that you can do, and I think that actually being able to do this right inside your own IRA and invest in different ways, it gives you a lot of ownership in your own retirement, which hasn't been the case for a long time. And it's pretty interesting when you start to see different facets of what's happening and in the economy, and looking at the different options that are available to you. A lot of people think, hey, stocks, bonds, mutual funds, and CDs are the only ways that you can invest. And it's unbelievable when you start to actually see what's out there, as long as you can do your homework up front and make sure that you have a viable investment. Because when you're learning this, there's always some things that cost you money and some learning curves that you have to go through. So as much homework as you can do up front will really, really reduce that learning curve substantially. So to give you a little bit of feedback on what we're going to go over today, I'm actually going to go over, picking the right custodian, which I think is really important, and some of the reasons why I actually go with UDirect and Karin is very key and something to pay attention to in detail as far as the reasons why, and I'll go over that in some time. Also, the different structuring components inside an IRA or a 401k and how you structure different investments. What prohibited parties exist and some examples specifically outlining those, because I think it's important. A lot of people think, oh, maybe I can do different scenarios, and sometimes there's a real thin line, and it's easy to make a mistake on that side. So we'll be going over some of those. The different IRA paperwork for those investment types that Karin was touching on, and what the backup is that is typically required when you're actually trying to invest your IRA funds is important to go over and understand, so that it doesn't delay your closing, and you can actually make sure that the custodian gets all of the right paperwork up front, and you know exactly what to do. UBIT and UDFI, unrelated business income tax, and something debt financed income tax, unrelated debt financed income tax. I have a slide on, and we'll be going over some of the specifics with regard to the pros and cons with regard to that stuff. And investment due diligence and also managing your investment is very important from the ongoing maintenance of this. You can do all the due diligence up front, but if you don't actively manage your investment on a consistent monthly basis, things can turn bad very quickly, and you want to be able to take action on any problems that do come up whenever you're investing in different avenues. So hopefully you can gain a good understanding of that. And we have a couple of questions here, basically saying, let's see here, one of the main advantages of real estate is the tax write-offs, but you lose that with the property in an IRA. Is there a way to structure it so that you have some of those tax loss advantages? And really, those tax loss advantages, you're already gaining some of the benefits by not having to pay tax on any of the income associated with it. And so there is some ways to take partial tax loss when it comes down to paying UBIT and UDFI, but at the same time, typically it's mutually exclusive from you personally, and you're already not paying tax inside your IRA, or it's deferred until the future. So some of these depreciation tax benefits don't really apply to you because you would have to recapture it anyways, and you're not paying tax on it anyways in the first place. So I hope that helps a little bit, but I don't see a full way of doing that in a lot of detail to get benefits personally from this, and it's actually prohibited to get benefit from your IRA in itself. To give a little bit of background of myself, I actually have bought and renovated and held or sold over 450 houses in the last 9 years. I'm a CPA, and yes, it was the hottest day on the beach in Hermosa Beach that day, and I was in a suit dying. So it was lots of fun to get these pictures. But right now I'm buying about 5 properties a month, and I've raised over 35 million in private investor capital, and I help a lot of different investors invest in different asset types. I've managed a 200 plus unit property portfolio in the Memphis, Tennessee and Atlanta, Georgia markets. And we primarily focus on single family and multifamily investments, and we own our own renovation and management company. So before real estate, before I actually quit my CPA firm job, about, I'd say, a little over 9 years ago. And my experience, what I was doing there was working with different CPA firms, helping them reduce their taxes, increase their bottom line as far as their net income, get proper segregation of duties within the different parties to try to mitigate fraud risk factors within companies. And some of my largest real estate clients were, or some of the largest clients I worked on were real estate clients that would buy large multifamily buildings that required audits. and I would go in and actually audit their books. So I got to see all the inner workings of the different costs that occur on multifamilies, the renovation side, and that type of activity. So it was a great knowledge base to start off with. And now I help a lot of clients with the real estate taxation, all of the different investment analysis and property management. Because we own a management company, we understand all of the intricate details associated with proper management and the lack of proper management. So, and then we also help clients with the legal and tax structuring. A lot of people go through and try to open up different entities way too soon before they've even started doing a deal in the first place. So it's definitely important to make sure you get the right advice with regard to what entities to set up or not set up before you get started in doing this. So we'll talk about a couple of different structuring components within your own self-directed retirement account as well. So what we do with our company is we actually buy single family homes and multifamilies and go through and help other investors invest in other promissory notes and different syndicated investments. Then we go through and add value by renovation or our management company and the efficiencies associated with that, and the whole operational side where we do all the due diligence up front, do all the quality control work and things like that. So, and then we provide those passive cash flow investments for ourselves or our investor partners, and we raise capital for those different investments on a consistent basis and are constantly going through and buying, consistently 5 houses a month, as well as multifamilies on a quarterly basis. And then we also help our clients with the goal planning and tax planning and that whole entity structuring component I talked about, and how to actually manage your investments on a consistent basis. So I think that focus is really, really important on managing your investments going forward. So many people think, oh, the numbers look great up front, and then they don't actively manage their deals. And it's really important to make sure the manager manages your properties the way you want them to be managed. So let's talk about the problem really quick. In my opinion, the problem is that these old investment methods that we've all been trained by the Fidelities and the Schwabs and the John Hancock mutual fund companies as the primary investment methods to retire off of, they don't work. What they're doing is they're creating a retirement community that is still working or dependent on other people to be able to live within their retirement. And we've seen this time and time again where you have different financial planners actually go through and tell you that, hey, this investment will last you through the end of till you pass away, and you will be depleting principal as you go, which is the wrong method to be thinking when you're thinking about retirement. You do not want to be depleting that principal. You want to have enough funds to be able to create passive cash flow that you can retire on without necessarily having to deplete the principal portion of that retirement. And it's extremely important to be able to focus on that and focus on investments that can provide you a high enough return to do that. These CDs and stocks and mutual funds don't necessarily provide you that cash flow that you need to retire off of. And it's not just that cash flow component. You want to be able to create more than all of your monthly expenses in cash flow, so that way you can cover these things during retirement. So if you have $6,000 a month, for example, in monthly living expenses, then you want to be making $10,000 a month coming in your cash flow from your investments, so that you can take the rest, put it into additional investments to grow that, so you keep up with inflation and keep building that. So then as your expenses grow, your income grows right along with it associated with that. So keep that in mind. Your expenses will grow over time due to inflation, and so it's really important to make sure you're focusing on a higher number to be able to reinvest proceeds on top of just covering your expenses. So let's talk about picking that right custodian. So some of the main factors that go into this, and the first thing that people think about is the fee structure. Now keep in mind, some of these other investment companies like the Schwabs and the Fidelities, those fees are hidden right inside your actual returns, and so it's very hard to determine what those fees are, and they're not actually required by law to tell you what those fee structures are. So what I really like about the self-directed custodians is they're right on their website 90% of the time. So Karin at UDirect has them all primarily flat annual fees up front for the services. And, it's a low annual cost versus some of the other fees that are inside a traditional custodian that you don't even see that really are much greater than the self-directed custodian fees. Now, you can have on different custodians, you have these flat fees, which I really like because you know what your fee structure is. There's that per asset fee or asset value fees that can grow over time based on your actual asset. And I really don't like that structure because it's really hard to gauge what your fee structure is. There's not much additional work on top of the amount of on top of the annual maintenance on that account that needs to be done when you add additional assets to that account. There's already, sometimes transaction fees and things like that that can exist, and that disclosure of fees, I think, is really important to compare them. And one of the reasons I go with UDirect is because of their fee structure comparative to other self-directed IRA companies. Other things to keep in mind is that transaction processing. So when you're closing on a real estate deal, you want to make sure that these different custodians can close quickly. And if you have your paperwork wrong or you do something wrong where you don't submit it, that they get back to you quickly to be able to resolve that issue and get the right paperwork over to them so that it doesn't blow your deal, because a lot of times these real estate deals can be very quick. And so you want to have a company that's very responsive, that does these things very quickly. And that's what I really like about Karen's company. She'll tell you that they're a little bit longer in transactioning time, but in reality, you're looking at a couple days usually in between. So it's pretty interesting once you have all your paperwork put in correctly. So, and that problem resolution is very important, to have the right customer service and that support team in place that can show you these are the documents that I need. And, if you're rolling over a document or paying off a document, going back and forth, having the right team member there is really, really important. And that education, just like what we're doing right now on the right structures, the right paperwork that needs to be in place, is very, very key. If you have, a company that doesn't focus on that educational aspect of things, then you may lack the knowledge to complete your deals, and then therefore blow a couple deals for you. So it's really important to have that. The quality control and the safety of your funds are also very important. So I wouldn't want to deal with a company that lets you skip by with not having all the paperwork in place. They're not there to manage your investments, and they don't take that liability on, but having somebody in place that reviews the documents up front is definitely very, very key to your success, so that you don't make a mistake and do something that you don't necessarily know. Like, for example, if you don't have the deed of trust for a promissory note along with the promissory note, when they say it's secured, then that's something to pay attention to, that the IRA company would check and say, hey, you don't have all your documentation here, or hey, it's not signed, and things like that, to make sure that you have that right documentation. Now, that's not their role, but they do those things mostly for their own liability purposes. It's your responsibility to make sure you have the right understanding of what documentation is required. So let's talk about the structuring here. Okay, so we have the custodian and the administrator here that typically are involved in a self-directed IRA. So you can do that type of structuring where every time you submit an investment, you submit the bi-direction letter to the custodian or the administrator, and they will actually go through and help you fund your investment and take care of the documentation and sign the paperwork where they're supposed to sign for the benefit of your IRA. There is a self-administered 401k, which I wouldn't necessarily recommend. You have a lot of people going through and doing this structure. Unless you're a professional and you really understand this in detail, and you have someone in place that can monitor this and help you with all the paperwork and the compliance issues associated with it, as well as the bookkeeping aspects of it, to make sure that you're not doing anything wrong, it's very dangerous to do this if in that type of self-administered 401k where you are the self-directed IRA custodian involved in itself. And I would urge against that unless you really know what you're doing and are very experienced. Then there's also the IRA-Owned LLC, where your IRA invests in an LLC that you set up, and you are the manager of that LLC with checkbook control. And therefore, you're basically setting up an LLC. It's a specialized LLC with a special operating agreement that it's not a typical operating agreement that you can go to LegalZoom and go put it together. You can't do any of that. It actually has to be owned by your IRA and have special wording in it. But once it's actually set up, your IRA invests its money in that LLC and buys the stock for the LLC, and so it can be 100% owned or a percentage owned by your IRA, and then the investments associated with that IRA are then all owned by that LLC, and that flows back right into your IRA tax-free or tax-deferred for the remainder, the end of till the end of the investment occurs. So you have your current 401k, you transfer the funds into your self-directed IRA according to the chart here, looking at this chart, and then you have your IRA LLC set up, and you buy the shares, and you are the manager, and the investments are owned inside the LLC in itself. And then we have different structuring of different investment types. So the typical investment types that I see within a self-directed IRA are promissory notes, which usually when you're submitting the paperwork there, you're looking at the specifics of the promissory note, the deed of trust, any other personal guarantees that go with that, any assignments of rents and leases that go with that, and possibly even some closing documents if you are going through a formal closing on a promissory note. When you're dealing with rental property, as Karin talked about, you're talking about the purchase agreement, the HUD closing statement, the full title insurance, all the documentation that goes along with it needs to go to the custodian so that they have it as backup associated with the property, and they'll typically fund directly to closing, and your IRA will be titled on the property in itself, unless you're buying it in an LLC that is owned by the IRA, like I previously discussed. And then also syndicated investments, very similar to the IRA-Owned LLC. You're just investing it in an entity that is actually run by somebody else. It's not run by you. It's a fund, or it's, call it there's multiple different asset classes that you can invest in, from multifamily investments to commercial properties, to any type of investment that you can possibly think of. You just want to be very careful to understand, is that syndication leveraging their money? Are they actually going through, and what are the due diligence steps to make sure that on a syndicated investment you are investing in a viable project with an operator that knows what they're doing? So these operators don't always know what they're doing, and so looking at their terms, looking at their assumptions inside the investment, their leverage amounts, all those things are important when you're looking at this. And when you're submitting it to the IRA, you're submitting it to, the subscription agreement and all the backup documentation that they give you for the syndication for them to fund directly to that operator. There are partnerships involved. However, you want to be very careful on partnerships and joint ventures and things like that. It's a very thin line. For example, with UDirect, it's very difficult to say that, to have a custodian feel comfortable with the liability of signing a partnership agreement. So a lot of times it's easier to deal with inside of an entity, or structuring it in one of the other ways, where your actual IRA owns the property in itself, and you may have a management agreement set up or something along those lines for different partnerships. So different custodians do it differently. So depending on the custodian you're using, you want to ask them what paperwork would be provided, and if you can do that within that IRA or that custodian. Now, some of the reasons for that is because there's a lot of new compliance and new regulation going in, and so they're being very careful to protect you, to make sure that they're signing the right compliance paperwork and that they're not at risk as well for any issues that could come up in the future. So let's talk a little bit about the prohibited parties involved. As Karin mentioned, she talked about the lineal descendants, the parents, the grandchildren, and the children, and things of that nature. You also have your spouses or business owners that are, you can have business partners that are, less than 50% owned, but it's a very, very thin line, and there's some specific rules involved when you have other business partners, like doing other outside business with them. And I have a couple of things here where you got to be careful of the self-dealing component of this and the present benefit rule. So this present benefit rule here, basically you are not allowed to get present benefit from your IRA, and your IRA is not allowed to get present benefit from you. So for example, if you have the funds personally to say you want to do a partnership with your IRA, which I would be very careful of in the first place. There's some really thin lines drawn there, and you have to go to an attorney or someone to be able to explain to you if you can or cannot do certain structures whenever you're doing this. And that present benefit rule can be a very thin line. So I always recommend not to do business with your IRA if you can at all help it, and if you have to absolutely do it, get an attorney involved that specializes in these prohibited party transactions and this present benefit rule. So basically, if you have $50,000 and your IRA has $50,000 and you want to both invest in a $100,000 property, then you probably shouldn't do it unless your IRA could do it itself 100% or you could do it yourself 100%, because what's happening is you are benefiting from the IRA's funds, otherwise you wouldn't be able to close on that deal. The same thing with your IRA, and so that would be a prohibited transaction involved there. And so you want to be really careful, because there's a lot of case law that will be coming up in the future with regard to these types of issues. And so you may do a transaction which later on may lead to case law from someone else's transaction, and then you found out later that you did a prohibited party transaction. So that's why I'm saying steer clear of anything that could be construed as a present benefit or a prohibited party, because it's very, very dangerous involved, and it could really result in some heavy tax penalties. So you also cannot provide services. You can't go manage and be the property manager and lease out your own property that is owned by your IRA. You can't go do a renovation on your own IRA. There's a lot of different things involved here that I think are important to pay attention to. You can't have it used by different prohibited parties. So here's a couple of examples. Your IRA purchases real estate, and then you or another disqualified person live in the property. And you can't actually go do that because you're getting a benefit, a direct benefit, or you're one of your other disqualified persons are getting a direct benefit for the use of your IRA assets. Okay? Your IRA purchases real estate, then it's rented out to an outside party at a discounted rate. That outside party explicitly or implicitly agrees to provide some benefit to you or another person that's disqualified in exchange for that discounted rent. So you're getting present benefit again in this situation. Your IRA purchases real estate, and at some point later time, it lacks the funds to continue paying its mortgage or the taxes or insurance or any kind of expenses for it, and you or another disqualified person cover that deficit. So that is not, you cannot do that because your IRA is getting that benefit associated with it unless you do a contribution to the IRA or bring in an outside partner involved that's not disqualified. You have personal funds to invest, but you do not meet the minimum investment amount, just like what I was talking about with the $50,000 investment. You direct or your IRA also invests along with your funds in order to take advantage of that opportunity, so you're receiving that present benefit. You or another disqualified person use your IRA assets as collateral to secure a personal loan. So an IRA assets can't be used as collateral. You're getting a benefit from that. So keep in mind, if you engage in these, your entire IRA can be fully distributable and taxable at that point. So why I say steer clear from these, because case law is still coming out on a consistent basis with regard to these types of things. So let's talk about UBIT and UDFI, so unrelated business income tax. So it occurs when you run a business or are deemed running a business inside your own 401k. So unrelated business income is income from a trade or business regularly carried on that is not substantially related to the charitable or educational or other purpose, which is the basis for the exemption in the first place. So you're specifically not allowed to run a business inside your own 401k or IRA. And it kind of relates to the frequency of occurrence here. So for example, on flipping properties, because I flip properties outside of my IRA, it can be construed as me actually taking doing a business inside my own IRA as well if I flip properties inside my own 401k or IRA. So you want to be very careful about how it looks, how it feels, the smell test involved, and things like that as well. And if you're constantly flipping properties inside your 401k, even if you don't do it, on the side yourself, it can be considered a business. And so some CPAs and attorneys say, one property is okay or 5 properties. It comes a lot down to the intent here. And so, the corporate tax rate is 39%. And so you want to really be careful about this, because that's what rate gets charged on your IRA or 401k. So on all that income associated with that business, and you actually have to file a tax return. So on the unrelated debt financed income tax, so when your IRA or borrows money, or an LLC which your IRA owns, which includes syndications, borrows money to purchase real estate, you're using leverage that is not included in your IRA. So the IRS says that portion, say you 50% loan, you got a 50% loan on your cost, then 50% of the income associated with it is taxable. Keep in mind, when you do this inside of a solo 401k plan, that it's exempt from UDFI tax. So a very big benefit on a solo 401k plan versus a IRA where you can borrow funds. So now let's talk about the really important stuff, which is, the investment due diligence in itself. So before ever investing in any kind of property or investment, you want to do some key things to make sure that you're getting a very good investment, and it's not going to cost you money to get those losses, so you avoid those losses that are really going to cost you, money down the line. So, that neighborhood analysis. Please, please, please don't buy the low-end stuff that's in the ghetto. I'm telling you right now from experience that really cheap property seems like a great deal, but in reality, when you do the real numbers, there's more vacancy, more bad debts, more tenant turnover, more vandalism and theft. You want to be very careful on your numbers there, and if you're going to buy in a bad neighborhood, you better increase some of those numbers, otherwise you're going to be at a negative cash flow situation or in a bad spot. The market value analysis, also very important, pulling comps and things like that on the property, looking at the rental analysis and pulling comps on those properties. On the renovation side, what is all of your preventative maintenance aspects? If you're doing a flip, you're actually looking at what things are going to show up on an inspection report that you're actually going to go and have to pay for later if you're flipping a property to a homeowner or somebody else. If you're doing a rental property, you're looking at what are the preventative maintenance items that are going to cost me money a year or two down the line, where where you may have problems. What about the AC unit, the roof, the foundation, the plumbing? I always get a full renovation analysis with a room by room breakdown with all the major items covered, with a disclosure checklist showing the age of the AC, the age of the roof, and I get a full inspection every single time with a side-by-side report done when on that report showing the inspection report pictures along with the items being fixed. So whenever you're investing, it's great to have that documentation. But reviewing those closing documents, making sure that you understand what those closing documents are saying, what fees are getting charged, what your title insurance is involved, and how much is getting covered on that title insurance. Your cash flow analysis, extremely important to understand your cash flow analysis, what your vacancy is, your vacancy assumptions, what your repairs assumptions, taxes, insurance, property management costs, and things like that. And if you're flipping a property, how much are you having to pay on a monthly basis in utilities and property taxes and insurance that are costing you money on a consistent basis. And then reviewing your return on investment analysis. After financing, how much money are you making on your money? It's very, very important to consider. Insurance coverage, also extremely important to understand. Not all insurance companies are created equal. Not all policies are created equal. In our policy, we get a 24-month loss of rents coverage in our rental properties if there's a catastrophe. Very kind of important and rare type of opportunity, when normally they might cover half or a 6-month period of time or something like that. They also go through, and we have a $10 million general liability policy on every single property that we purchase. And we also get a policy that covers the 100% replacement cost instead of what's called depreciated value. So very important stuff. And then understanding the property management, very, very key. What are their experience requirements? What are the different things the property management should actually be doing for you? So, again, looking at that inspection report, getting pictures and videos, getting that comparable property analysis and all the profitability analysis, looking at the tax assessor's report. These are some of the backup things you can do when you're looking at these different items. The marketing material, putting that together if you need to raise capital for the project and things like that. So let's talk a little bit about team members because I don't have a whole lot of time left. I have to move forward. I'm sorry. I appreciate your guys, going through this with me, and it's important to hit all these items. But the property management is very, very key whenever you're holding any kind of rental property. Your team will make or break you, and your property manager and your rehabbers are really, really important. So looking at those contracts to understand them for, the right incentives. The monthly fees involved. Ask for those references and their experience with the laws and liabilities in the state that they're doing business with. They need to understand the tenant landlord laws, or you can get sued for doing that. So, how many properties do they manage? Do you understand their property management statements on a monthly basis, the accounting statements, and do you have questions with regard to those? Are they easy to track? What are the additional costs involved that they charge you for? Do they charge you for advertising costs? Do they charge you monthly fees, whether it's vacant or rented, which some management companies try to throw things in there where they get a $50 flat fee either way, if it's rented or not. So, and they have their arguments, which are invalid in my opinion. But, cheapest is not always the best. And do they communicate with you? How soon, how often? You have to train these management companies on how to communicate with you based on what you like. So it's really important. Teams of rehabbers, you can test them with smaller jobs. We always use teams because what happens is their time gets longer. If you're using one team member over time, their quality goes down, their costs go up. So you have to be able to take those things away from them if they're actually going through and doing that and taking more time. Looking at their renovation bids, are they polished on those renovation bids? Having time frames involved in those renovations and putting those in the contracts. Never do a renovation without a contract. Always have that contract in place so there's penalties for taking too long and bonuses for not taking for doing it faster. Okay. And what warranties do they pay for as well on their renovation? So other team members, brokers and bankers and private lenders are really important aspects of your team. Affiliates and insurance agents, a CPA and an attorney in each market that you're doing business with, and with attorneys especially, the different laws that exist and the different types of law. You need an attorney for the different types of law. Realtors, inspectors. Inspectors are not always created equally. You want to have somebody that will go through that report with you in detail and actually explain to you what their experience is with those items. Selling and buying agents, appraisers, and bird dogs, all important. And you want to have that A team put together on this that actually really kicks butt for you and can communicate with you correctly. And I can tell you, if they're not communicating with you, then they're not good team members in any way, shape, or form. Very, very important. So managing your investment, the thing that I think is one of the most important aspects of this, and managing those mortgage payments, those taxes and insurance, that can increase the property management aspect and fixing it fixing it if there's inefficiencies involved, looking at the vacancy rates that you have, what other miscellaneous expenses occur, when should you increase rents on a consistent basis, you're looking at that annually, managing those property managers and looking at their monthly statements, tracking the collections yourself if they're behind in rents, asking questions constantly and following up if they don't answer you, obtaining that tenant documentation, that application, and even getting it updated on a continuous basis if they move out on you or something like that. So, and telling them how you want to run your property, and with their experience, of course, giving you that feedback. Quarterly and annual ROI analysis, reviewing your numbers, reviewing the tax and legal implications for the proper planning, keeping an eye on the market, and staying informed with what's going on in the economy, and keeping your books up to date. You know how many times people don't do that? It's crazy. So let's talk about what happens when you're investing in any type of asset. So, obviously when we're doing this, our worst fears shoot into our heads and we think the worst case scenario, and it's about writing down the risks and how to actually get through those things. So, if you're worried about the worst case scenario of losing money, or, there's a fire, or what if you can't rent it, or the rehab is bad, you can do specific things to manage that risk by, making sure your money is always secured by an asset, having the right insurance in place, or having a management company that guarantees a tenant after a certain period of time of vacancy, having a renovation guarantee, or having your proper inspection and backup documentation there, going through and actually investing in the right markets for, that crazy depreciation like here in California, though, we may get a big drop in values if the market changes. I say everyone's going to laugh at you as being a risk, which is really the case when they don't understand what you know. And I say, who cares? Because you've done the right due diligence up front on these things. And, you're by not moving forward with any specific investment, whether it's with us or anybody else, it's really important to analyze this in a very good situation and a very, very detailed, and making sure that you understand what your true risks are, and if you've really been able to come to the right due diligence steps to make this a viable long-term investment. So let's see, how we make money with our investors is we actually invest in different trust deeds and they can invest with us. We buy and hold properties. We actually partner with different investors on joint ventures. We have investors that help make money with us by finding projects and raising capital for us. We have different syndicated investments. We do real estate consulting and goal planning for investors, as well as the tax structuring and the bookkeeping component of it. And we sit down with our clients and really help them for free in the beginning to help them with those different aspects and understanding the right circumstances. And so, I think learning about money is the most important thing you can do, and having someone on your team that can help you with that is very important. And I have a favorite quote, which is, one part of me is a hardcore capitalist who loves the idea of money making money. The other is a socially responsible teacher who's deeply concerned with the lack of financial intelligence among society as a whole. And it's because it's not taught in schools. It's really important to get that education yourself on the side through constant webinars and different educational courses, going to different classes that you can learn, and really analyzing your own financial situation, which is, what are your next steps to this financial success, starts off with your strategic financial plan, which is assessing your current financial situation. What are your assets and liabilities? What is your current income and your expenses? If you don't know those things, then you need to start there, because you don't know what your goal is in the first place to come to. How do you know what your capabilities are without assessing that? Finding ways to reduce your expenses and your taxes, and getting educated on the right legal structures to do that, and finding ways of increasing your income. I don't care if it's selling stuff on eBay to get your stuff up. Everybody has stuff around their house they want to get rid of and they just don't do it. Go sell it on eBay, go sell it on Amazon, sell it in any way you can to make additional income on a monthly basis. Find ways of continuing that even on a passive scale, and setting the right financial and life goals for yourself. You have to have a specifically clearly defined goal in place, and you need to have a desire to get that done. So in order to have that desire, you have to know what your outcome is going to be. Is it spending more time with family? Is it making sure that you're able to go to the gym every single day and live the life the way you want to live your life? And that goal, for example, for me is gaining $50,000 a month in passive cash flow to cover all my monthly expenses, and then some, to be able to retire and be able to teach more to other investors, so that I can actually grow my wealth and grow my own relationship base as well, and help other investors invest in this stuff. So keep like a clearly defined goal where you have specific steps to get there. So I plan on doing this through buying multifamily properties, buying single families, flipping and holding, and doing different asset classes that I understand and invest in. And you have to get educated. through training your mind daily through these different books and audio tapes, writing down your affirmations. What are you plan on doing? How do you want to live your life every day? And taking action. Your knowledge is useless without taking that action, and you do that through training your mind daily, like I was talking about through the books and tapes, and masterminding with the right people that have that same mentality and mindset. So the more you achieve in your life, the happier you will be. And I really believe that. Like if you feel like, you try to get through this pain point of going to the gym, or this pain point of, studying for 5 hours straight on something that's really important for you to learn. At the end of that, you have a very, very high gratification rate. It's like if you went to the gym every day for 3 months straight, how amazing would you feel to be able to do that every single day? It's however, the more you get through this short-term pain, you get to that long-term happiness, and it really happens like that every portion of your life. So really important to do. That being said, speaking of education, we have a couple of events coming up. I run a group of investors called For Investors by Investors, one in Long Beach and one in the South Bay, where we just teach. No sales pitch allowed at any of our clubs. We just actually educate. And so we're doing one on breaking into any out-of-state real estate market in November 19th in Long Beach, and in South Bay we're doing one on international real estate investing. It's a panel, so you guys can see the cost there. My Long Beach group is on the last Thursday of each month, but this month it's moved forward because of Thanksgiving holiday. And then we do more of a speaker or roundtable discussion with Q&A. And then in the Manhattan Beach one, we do a panel discussion. So we'll be bringing in different professional investor panelists. And then I'm doing a live event in Manhattan Beach on retiring and out-of-state investing. And whether that's out-of-state investing or passive cash flow investing, it's really important to understand that aspect and how to retire off of passive cash flow. And I'm doing a free course on Saturday morning from 9 to 11. So it'll be a quick, easy type educational session that I think would be really valuable for a lot of people to attend. And I can send you guys these slides later on if you really want to delve into some of the due diligence aspects of this stuff. And so that's pretty much it. If you guys want to know more or want to learn more, you can always email us at invest@ocgproperties.com or go to our website, ocgproperties.com, and check us out. If you email us, I'd be glad to sit down with you for 30 minutes and talk about your specific financial situation for free and just go over that for you and be able to help you any way I can. So this is how I add value to my clients, is trying to help them without really expecting much in return. And I go through and really sit down with them to delve into their specific situation, no matter what it is. So that being said, thank you guys very much for joining us today. Again, you can email khall@udirectira.com to get her free book, and you can email me at invest@ocgproperties.com, and I'd be glad to help any way I can. Thank you guys very much today. I appreciate your guys' time. Talk to you soon.